Hi, Tom here. In this lesson, what I want to do is I want to introduce you to 5 really popular chart patterns. And I will also show you the strategy that is used for trading these patterns. So it's a bit of a longer lesson, but I want to explain the theory and as well show you the practical application of these chart patterns. So let's get started. The flag pattern consists of 3 main components. Firstly, you have the flagpole, like so, and this is the initial sharp price movement that forms the base of the pattern. And then you have a consolidation phase, where the price just goes up and down, and this will form the shape of a rectangle or a parallelogram. And then you have the breakout. And the breakout from the consolidation phase is the direction of the previous trade, which means that prior to this initial bolt in price movement, the price was trending up. And then when you have the breakout here, the price will continue trending up. What I've shown you here, it's the bullish flag. And what you can also have, let's just show you, you can have the price going down, down. Then we have the consolidation, which is usually a parallelogram, and then the price breaks through and goes down. So in this case, you would have a bearish flag pattern over here. So how do you trade it? Okay, let's say you have the price movement like this, consolidation here, and I'll change colors so it looks a little bit nicer. Here's the parallelogram. It always trades in a parallel. That's the key characteristics of the flag pattern. So you're waiting for so you see the flag pattern and you're waiting for the breakout. Breakout happens right here. So this is your entry level point. Next, you set up your stop loss, and the stop loss is just below the flag. So it would be over here. And then you need to set up your take profit area. So what you want to do is you want to measure the length of the flagpole, which is here, and then you would measure the equivalent like so, and then you have your take profit area. So depending on the length of the flagpole, these entries, it's sometimes a risk reward ratio of say 1.5 to 1, but it can be 3 to 1. It all depends on the shape and the characteristics of the flagpole. So now let's check how this would look on a real life price chart. Here I'm on the US dollar Japanese yen, and by what I see here is I see an example of a flag. Here's what I see. Here we have the flagpole. Goes all the way up to here, and then we have price starts to consolidate in, let's say, sort of a parallelogram. So we can draw the upper trend like so, and then the bottom one is like this. And just to make it look a little bit fancy, I can add this bit. So yeah, we have the burst of energy here, price moves up, and then we can see it bounces between the upper limit and lower limit a couple of times. So we have 1, 2, 3 touches of the top level, 1, 2, 3, 4 touches of the bottom level, and then it breaks out. So we would enter our long position once the price breaks above the upper limit. So around about here, we place the stop loss below the lowest area of the flag. So it is here. And to calculate the take profit distance, we will just calculate from the top of the flag to the bottom of the flagpole. So in this case, let me zoom out a bit. Well, in this case, it's a big flag, so the take profit will be something like this. Okay, let's see if this would have been profitable. Okay, in the end, this would have been quite profitable. And as you can see, the thing which I like about this pattern is that the risk reward ratio was 2.31, which means that for every dollar you invested in this trade, you would have gotten $2.32. Here I have another example of a bullish flag. So we have the flagpole like this, and then we can draw the upper limit like this and a lower limit like this. And just to complete the picture, like this. Now we would enter the trade here once the upper limit is penetrated. We set the stop loss below the lower limit of the flag, and to calculate the take profit, we actually calculate it from the top of the flag to where the price action started. So this will be our take profit area. And let's see what would happen. Okay, and this would have been a profitable trade. A really good risk reward ratio, which means that for every $1 we invest, we get $2.21 back. Okay, good trade. Okay, so the head and shoulders pattern is actually very simple because all it essentially is a series of 3 peaks. So let's say you have the price here. So you have the first peak, which makes up the left shoulder. Then you have a head, and then you have your right peak. So I've drawn this like this so that it, well, let's say sort of resembles the shoulders and the head. So you have the peaks. This means that you have the top and the bottom. You've got the high of the middle peak, the bottom, and a top here. So essentially, this is the head and shoulders. What you need to pay particular attention to is that the 2 peaks at the bottom, the 2 low points after the first peak and after the head peak, you can connect them, and they make up the neckline. And the neckline is very important for this pattern because the neckline is the support zone. And once the support gets broken here, this will be a sign that this is an actual head and shoulder pattern, that the price is reversing and you want to sell at this point. So you want to go short at this point. What typically happens with this pattern is that once the support is broken, well, then the support line becomes a resistance. So this price is very common, actually will go back up to around about this level, bounce off the resistance, the new resistance, and then go down. So how do you enter it? So essentially it works like this. Let's go with a light blue this time. So once the neckline is broken around about here, then you enter the trade. And you want to set your stop loss just above the top of the right shoulder. So here you have the stop loss. Now you enter here. Here you have the stop loss. Now the take profit area, well, it works like this. You have to measure from the neckline all the way to the highest peak. So this would be like this. And you take this distance, take this line, measure it out, and then over here would be your take profit area. And that's a very simplified way, but this is essentially how the pattern looks. Series of 3 peaks. Then you have the neckline. Once the neckline is broken, you enter the trade, you go short, set the stop loss above the right shoulder, select the take profit, add the distance, you calculate the distance from the neckline to the top middle peak for the head peak, and then you create your take profit here. When you look at the real chart patterns, you will notice that you really need to calibrate your brain to recognize the pattern and recognize the differences, because not everything is a textbook example, so you really have to learn how to identify it in a real live action price chart. I'm here on the Euro British Pound chart. I'm using the 1 hour time frame, and I have found a perfect example of the head and shoulders. And remember, head and shoulders is a series of peaks, 3 peaks to be exact. So here's what I'm looking at. We have the left shoulder here, then we have the low point here, top of the head is here, another low point is here, and then the right shoulder is here. So I can draw a line like this, and this is the neckline. So as you can see, there's the left shoulder, the head, which is higher peak than the left shoulder, and then we have the right shoulder here. when the neckline is broken, that's your time to enter the trade. And to calculate the take profit area, we just measure the distance between the neckline and the top of the head peak. So this is the take profit area in this trade. So it will look something like this. Okay, neckline gets broken around about here. We place the stop loss just above the right shoulder, and then the take profit is around about here. So this gives us a risk reward ratio of 1.36, which it's okay. If we were patient, well, the potential in this particular trade was much better. But let's move on. Okay, here I see something again. It's the beginning is a little bit different, but this qualifies still as the head and shoulders pattern. So basically, we have the left shoulder here, we've got the head, and then we have the right shoulder. The neckline would be drawn like this. Price was penetrated here, so this is where you would enter the trade. But let's move. Maybe I can see something a little bit better. Okay, this one here, well, technically we have the left shoulder, head, right shoulder, but because the price just moved so quickly, you probably wouldn't have caught it, so this is not the best example. And then here we have another actually really good example of the head and shoulders. So this is what I'm looking at. We have the top of the left shoulder here. Here's the low point. Top of the head is here. Here's the low point, and then top of the right shoulder is here. So we can draw the neckline like this. Now to measure the take profit area, we start measuring from the neckline to the top of the head. So this is the take profit area. And the trade would look something like this. So neckline was broken here. Let's say we entered the trade. We place the stop loss just above the right shoulder, and then here's the take profit area. So in this case, the trade would have been 1 to 2.13 risk reward ratio. And if you were patient, again, if you're using a different take profit strategy, well, the chances were to have a much bigger risk reward ratio. But I have found that when you're starting, it's just good to use this distance as the default take profit area. And I mean, this trade, 1 to 2.18, this is a good risk reward ratio. The double top. This is a bearish reversal pattern that appears after an uptrend. Here's how you identify it. First, you have the uptrend, and then the double top pattern consists of two peaks that are approximately at the same level. Okay, something like this. So you have peak 1 here, peak 2 here, and then it's very important to make note because you have a trough or a valley between the two peaks here. And what you can do is you can draw a line like this, because this is the support, or in this particular pattern, I will call it a neckline, just like in the head and shoulders pattern. So how do you trade this pattern? Well, first you have to identify it. Price charts are often messy, so you have to pick something that more or less resembles this type of pattern and then understand the features of these patterns, because not everything is a textbook example. So once you see an uptrend, the two peaks and a valley over here, what you do is you draw the neckline and then you wait for the neckline to be broken. So once the price breaks the neckline, then you have an entry point. So this is your entry. As for all trades, you need to set a stop loss. So the stop loss is just above the highest point. This will be your stop loss. And then the take profit area, what you do is you measure from the neckline all the way to the highest point and measure the same here. And then this will be your take profit over here. Like so. And that's the general trading strategy of the double top pattern. The significance here is that the two peaks, they have to be at a similar range because they cannot be uneven. They have to be close to each other, because what it indicates is that the price is struggling to move higher, and therefore it may reverse its direction. So this is the theory. Now let's see how it looks in an actual chart. So here I found a good example of a double top pattern, and I'm on the Australian dollar US dollar chart and using the 1 hour time frame. This is what I see. I see a strong uptrend, and it forms the first top here, turns around, creates a valley with its bottom here, goes back up, creates the second top here, and then it will go down. Drawing the neckline, it will be like this, something like this, because we have a resistance here, and then it finally breaks through the neckline, bounces off the neckline. Here we can see it attempted to break through, it didn't work, but the second attempt did work, which means that we can place our short position here once the neckline is broken. So we set the stop loss just above the second top point. We calculate the take profit by calculating the distance from the highest point to the neckline, which is around about here. And then we set our take profit at this distance. And well, in this particular case, it would have been okay. Not every pattern will result with a profitable trade. Nonetheless, what I have shown you here, it's a good example of a double top pattern. I'm on the USD Swiss franc chart using the 1 hour time zone, and I found a really good example of a double bottom. So we have a downtrend, creates the first bottom here, then it makes the valley, second bottom here, goes past, and I think this is going to go much higher than this. We can draw a neckline right about here, and the good thing here is that we can see that there was, this is the neckline, but we can see that, well, price was moving around about here and price was struggling to break through, but finally did break through. So in this particular trade, we would enter a long position around about here. We place the stop loss just below the second bottom, and then the take profit, we calculate the distance between the neckline and the lowest point of the price. Move it up. Let's move it like this. And our take profit will be here. So in this particular case, well, it would have been profitable, but let's see what okay, yeah. So it's a good example where the double bottom signaled a change in trend direction. And as you can see, when it went past the 200 period moving average, the trend changed into an uptrend. A falling wedge pattern is a bullish chart pattern, and it forms when price action is confined within two converging trend lines sloping downward. So the key characteristics of a falling wedge include downward sloping lines. This means that both the upper and the lower trend lines slope downward, and then the price just bounces off them. And the two lines, they are converging lines. And this is very significant because it indicates a decrease in volatility. An additional step that you can take to confirm this chart pattern is check the volume, because generally speaking, there is a decline in volume. So typically, as the pattern forms, there is reduced volatility, which is why the lines are converging, and there is a decline in volume. And that's the falling wedge pattern. And what makes this pattern special is that this is the pattern. It doesn't change whether it's an uptrend or in a downtrend, except in an uptrend, a falling wedge means a continuation of the uptrend. So the price temporarily moves lower within the wedge, only to break out higher and continue the uptrend. However, when you see this in a downtrend, this means that the falling wedge serves as a reversal pattern. The price action consolidates within the wedge and eventually it will break out higher, reversing the downtrend. I'll show you how you trade it. So the first thing is, as I mentioned, you identify the converging trend lines. Once you have this pattern set up, you wait for the breakout, which happens here, and this is your entry point. You set the stop loss below the lowest point of the wedge. So in this case, it would be here. So this is the stop loss. And when it comes to calculating the profit, what you do is you take the widest area on the wedge. So in this case, it would be the distance from here. Oh, wait, let me fix that. Would be distance from here. So you would calculate this distance and you would project it upwards like so. And then this would be your take profit area. Let's go to a chart and I'll show you how this works in action. I'm on the US dollar Canadian chart and using the 4-hour time zone, and I have found a good falling wedge example. So here we have it. The price is in a downtrend, and then over here we can see that the price starts bouncing up and down between two lines. Both of the lines are converging, which means that the volatility is becoming smaller and smaller. And we get the sign to enter the trade when the upper limit is broken. Now remember, the falling wedge is a buy signal. Once the upper limit is broken, it's time to buy. So this is how the trade would look like. We would enter a long position here. We set the stop loss just below the bottom point of the falling wedge. And the take profit, we would calculate it as the distance between the start of the wedge, the upper barrier and the lower barrier. So in this case, the take profit would be around about here. So this is an example of a falling wedge pattern. And in this particular example, it happens during a downtrend, because the rounded top indicates a bearish reversal, while the rounded bottom suggests a bullish reversal. So let me show you what it looks like. So the price, let's do a rounded top. The price is going up and down. And then at one point, again, it's going up and down, but it's like more gradually. You still have all the dips and highs. And essentially what the pattern forms is a rounded top. And from the beginning to the end, you can draw a neckline, just like in the head and shoulders pattern. So what you're looking for here is, visually speaking, it should be like, say, half of a circle. So to summarize, the key characteristics of this pattern is you have a strong uptrend leading into the rounded top. You have a gradual and smooth transition where the price peaks and starts to decline, forming a dome shape, circle shape, whatever applies to the chart pattern. And then you have a breakout below the neckline, which means the entry point is here when the price breaks below the neckline. So how do you trade it? Well, after the neckline is broken, you set your stop loss just above the highest point, and then you take the measurement from the highest point to the neckline, and you make the projection that this will be your take profit area. And that's all the theory there is to the rounded top pattern. I'll show you what it looks like on a price chart. Here I am on the Euro British Pound 4-hour time frame, and I found a perfect example of a rounded top. So here's what I'm looking at. This peak here, it has the shape of half a circle, it's rounded. And when we look at this here, we have some resistance here, here, and here. So we would draw the neckline like this. So when we are entering the trade, what happens when the neckline is broken, around about here. So the trade would look like this. We would enter here. We place the stop loss just above the top of the high point here. And we measure this distance to calculate what would be our take profit area. So the line is this long. So the take profit area would be here. And in this case, would have been a profitable trade. In fact, if you wanted to apply a different strategy for the take profit, you could set it up, for example, here, or you could set it as 1.5. I think that would be okay. Risk reward ratio of 1 to 1.5. But the strategy goes in this particular pattern, it's just place the stop loss above the high point, and that would be your take profit area. Okay. Here I have a good example of a rounded bottom. This is what I'm looking at. This area here, it's more or less a rounded shape. As you can see, it went down and it's gradually starting to make higher lows and turn around. And we can draw the neckline like this. And the neckline is good here. Actually, let's extend it because we see what happened here. But the neckline is good here because we see it was tested 1, sort of 2, 3, 4, 5 times. So we have the neckline here, rounded bottom. Now we enter the trade when the neckline was broken. So we would go long, round about here. Take profit is below. Set your stop loss below the lowest point of the rounded bottom. Calculate your take profit by drawing the distance from the neckline to the lowest point. So we can set the take profit around about here. And in this particular case, the trade would have been good. But I like this pattern because, yes, it's a rounded bottom, and as you can see, sometimes you have to be creative. What you have to do is you have to look and see at the gradual changes. So like here, it started curving and then started making higher lows, which meant a change in trend direction. Okay.